Hi viewers, welcome to the third video series of the Debt Mutual Fund Basics. In our previous video, we talked about the different risks of a debt mutual fund. In this series, we will continue our journey in discussing different types of debt mutual fund. In this series, we will focus mainly on the debt funds according to their maturity, investor appetite, risk versus return. Please stay till the end to see all the debt fund details. With this, let's begin our journey into the types of debt funds. There are different types of debt mutual funds. This debt mutual fund can be divided into two groups according to their maturity and according to their investment style. If we look at the maturity, some of the debt funds can be categorized from 0 to 3 months and which is called liquid fund and money market fund as well. 3 to 12 months known as ultra short term debt funds, 1 to 3 years which is a short term income fund and long term income fund ranging from 3 to 10 years. If we look from the perspective of investment style, GILT fund, dynamic bond fund, corporate bond fund, fixed maturity plans, credit risk fund, monthly income plan are the prominent ones. There are a few more, but which we will not be discussing in this video, like floater funds, conservative hybrid funds, aggressive hybrid funds, etc. All of these funds are basically the choices for the investors looking at their age and risk profiles. These funds are for moderate risk takers and provides a moderate return over a period of time. Let's talk about the liquid debt fund. The liquid debt fund is a good avenue to park the surplus amount of money. It provides a better return than fixed deposits and recurring deposits. The liquidity of this fund is very high. It is usually a short duration fund ranging from 0 to 90 days. All the portfolio managers who manage this liquid debt fund, they invest mostly in the money market and they use to maintain high level of liquidity. These funds are used by the corporate or business operations group. Whenever they have surplus amount of money and they have few days in hand to circulate that money for their business needs, they used to park that money in the liquid debt fund. The return for this liquid debt fund is less because the exposure to investment grade instrument in these debt funds are very high. At the same time, this liquid debt fund invests in very low risk investment which guarantees the return in the short term. Some of the examples of liquid debt fund are ICICI Prudential Liquid Fund, Mirai Asset Cash Management Fund, Tata Liquid Fund, Axis Liquid Fund, etc. Let's talk about ultra short-term debt fund. Ultra short-term debt fund usually invest in the fixed income instruments whose maturity period ranges from 91 days to 12 months. This is quite secure debt fund and provides protection against interest rate risks. However, it is not immune to the market fluctuations. It is suitable for the investors who does not want to take more risk and want to park their money for the short term. There is no exit load applicable if the investor withdraws the money after a month from this fund. The return for the ultra short-term debt fund is higher than the liquid fund, but exposed to the market fluctuation risks. This fund is considered to be superior than fixed deposits and liquid fund. Some of the examples of ultra short-term debt funds are L&T Ultra Short-Term Fund, SDFC Ultra Short-Term Fund, Kotak Savings Fund, Quant Money Market Fund, Aditya Birla Sun Life Savings Fund. The short-term debt funds are sometimes called income fund. This type of fund provides better diversification to the portfolio of an investor. The maturity of this income debt fund varies from 1 year to 3 years. Sometimes it goes up to 4 years. The exit load for this fund usually varies from 5 days to 1 month. Investors are charged 1% exit load if they redeem the fund within this time range. This fund is bought by moderately risk-taking investors who can afford to absorb the risk of interest rate fluctuation. One thing to remember, when an investor buys this fund, they have to check the yield to maturity parameter. Yield to maturity shows the average maturity of the securities held by the mutual fund. The lower the maturity period, the less interest rate risk is valid for this fund. The return of this fund can go up to 10% over 4-year period, while fixed deposit or liquid fund return ranges around 7%. For this rate of return, the investor has to take interest rate risk, credit risk, and inflation risk. The investor has to do a little bit of research in understanding the risk grade of the securities invested in this mutual fund. The greatest advantage of this fund is to provide tax relaxation when the investor holds this fund for more than 3 years. One important thing that investors should remember: the yield to maturity should be a less number. The less it is, the more better the short-term income debt fund. Some of the examples of short-term income debt funds are Mirai Assets Short-Term Fund, L&T Short-Term Bond Fund, ICICI Prudential Short-Term Fund, HDFC Short-Term Bond Fund, and Kotak Bond Short-Term Plan. Let's see what is the long-term income debt fund. Long-term income debt funds, otherwise known as long duration fund. This fund usually matures in more than 3 years and ranges till 10 years. This category fund are very sensitive to the interest rate risk. An investor who has moderately high risk taking ability invests his money in this kind of debt funds. The return of these funds soar high whenever the interest rate is decreased, and the return moves south when the interest rate is more. There is a parameter called modified duration, which indicates how much effect of the interest rate risk impacts upon the fund value when there is a change in the interest rate. Investors should look forward to this modified duration before investing in these bonds. For example, if the modified duration is 2, then 1% change in the interest rate will affect 2% change in the value of the debt mutual fund. Risk for this long-term income debt fund is high because interest rate risk fluctuates over a longer horizon. The risk for investing in this long-term debt fund is higher than the short-term or liquid fund. Usually some of the dynamic bond fund, GILT fund, and long-term income fund falls in this category. This fund provides a good tax relaxation if it is held by the investor for more than 3 years. Some of the examples of long-term income debt funds are SBI Magnum Income Fund, ICICI Prudential Long-Term Bond Fund, Aditya Birla Sun Life Income Fund, and HDFC Income Fund. Let's look at the debt mutual fund from the investment theme perspective. The GILT funds are the secure fund in terms of credit risk exposure. The GILT funds are issued by government for a long duration. GILT funds are ideal for low risk and moderate returns. Although these funds have no credit risk, it does have interest rate risk which is high. GILT funds are different than bond funds. While bond funds invest in little risky assets like corporate bonds and private commercial papers, GILT funds never invest in these bond instruments. GILT funds are backed by government issued securities. Investors who are risk averse and want to invest in government securities usually invest in these bonds. GILT funds return goes as high as 12%. However, return in this fund are not guaranteed and exposed to the interest rate risk. If the goal of investment is 3 to 5 years, then GILT fund can be an asset to be in your portfolio. Some example of GILT funds are Aditya Birla Sun Life Government Securities Fund, SBI Magnum GILT Fund, UTI GILT Fund, IDFC G-Sec Fund. The second type of theme-based fund is Dynamic Bond Fund. These are very popular funds nowadays. Dynamic bond funds are the creative funds to take the advantage of interest rate risks. Here, the fund managers of the debt fund diversify their fund assets into multiple interest rates varying over range of maturity period. This is an open-ended mutual fund where the portfolio manager actively trades the bond and securities to adjust the maturity period of the mutual fund. When the interest rate goes down, the long duration bond funds are profitable. But in the higher interest rate scenario, the long duration bond fund loses its value. Dynamic bond funds beat this interest rate volatility by trading these long-term bonds to switch to short-term securities. Before choosing a dynamic bond fund, please do a little bit of research about the fund manager and try to understand during the falling rate of interest scenario how the portfolio manager performed. Dynamic bond funds performance depends on the fund manager's quality and experience. These schemes are meant for moderate risk takers and not fit for the conservative investors. Investments in this fund should be held at least 3 years to qualify for long-term capital gain tax relaxation. The return in this type of mutual funds may take more than 3 years to fructify. Some of the examples of dynamic bond fund are SBI Dynamic Bond Fund, Kotak Dynamic Bond Fund, ICICI Prudential All Season Bond Fund, IDFC Dynamic Bond Fund. Corporate bond funds are a certain type of debt mutual fund which invest money in the big corporates. Corporate bond funds are safe haven for many investors with some degree of certainty in return. Usually, corporates borrow money to run their day-to-day operations. If they go to financial house to borrow the money, it might cost them more. Hence, they used to issue the bond and non-convertible debentures or commercial paper with lower interest rate to retail users like you, me, and other people. Hence, when you are investing in a corporate bond fund, basically the big corporates get money from you to run their operations. Any mutual fund which buys such bond papers from the corporates are called corporate bond mutual debt fund. Usually the investors who are little risk averse, they can buy this debt mutual fund as it provides better return around 8 to 10% over a period of 1 to 3 years. Corporate bond funds are exposed to the credit risk. If the mutual fund has invested in high investment grade bonds, then the credit risk is minimized, but return would be low. If the fund house has invested in the non-investment grade, the rate of return might be high, but it is exposed to the credit risk. The example of some of the corporate bond funds are Kotak Corporate Bond Fund, HDFC Corporate Bond Fund, Aditya Birla Corporate Bond Fund, and ICICI Prudential Corporate Bond Fund. Fixed maturity plans primarily invest in the fixed income instrument such as certificate of deposit, bonds, commercial papers. The fixed maturity plan debt funds are known to be closed-ended. These closed-ended funds cannot be redeemed before its maturity. Hence, if an investor is invested through fixed maturity plan, he has to serve the whole maturity period before he gets his money back. The objective of the fixed maturity plan is to generate a predictive return over a maturity period for a fixed amount of investment. This type of fund usually open through new fund offer, and during this period, investors are allowed to invest their money to buy the units. Once the NFO period is over, investor will not be allowed to invest any money. This fund is beneficial for the risk-averse investors who want to generate income at the maturity. This fund is less sensitive to interest rate risk and credit rate risk since it is locked in for the fixed maturity period. With a fixed rate of interest, it is not exposed to the interest rate risk. This fund invests money in high investment grade securities, hence the credit risk is minimized. This fund provides low to moderate return and competes with fixed deposits. However, it provides tax benefit which a fixed deposit does not provide. Some of the examples of fixed maturity plan funds are ICICI Prudential Fixed Maturity Plan, HDFC Fixed Maturity Plan, Aditya Birla Fixed Maturity Plan, and IDFC Fixed Term Plan. Credit risk funds are highly risky among the debt funds. The credit risk mutual fund invests in lower investment grade securities whose credit ratings are less and provides a rewarding return of 2 to 3% extra compared to a normal security. The credit risk funds are exposed to the credit quality of the securities as it provides an opportunity for the fund to get return either by acquiring the coupon payment arising from the securities or by finding benefit from compression yields. Usually, the investor who have good risk-taking capabilities should opt for the credit risk fund. As the money is invested in the lower grade securities, there is a chance of default, and that's why this fund is the riskiest fund among all the debt funds. While choosing this fund, an investor should consider the performance of the portfolio manager and also he should look forward to the size of the fund. If the size of the fund is larger, then sporadic incidences of default will have lesser impact compared to a small corpus fund. The return of this kind of risk funds are usually high. Mostly 2 to 3% extra return is expected when compared to the risk-free investments. This fund gives dividend distribution opportunities and as well as the capital gain opportunity when the securities gets bumped up from lower rating to higher rating by the rating agencies. It is held for a long time. The investors get the tax indexation benefit if he holds it for more than 3 years. The example of this kind of fund like Invesco India Credit Risk Fund, ICICI Prudential Credit Risk Fund, IDFC Credit Risk Fund, HDFC Credit Risk Debt Fund are some of them. This type of debt funds, as the name suggests, provide monthly income to the investors. Along with debt, this plan has some amount of equity exposures like 10 to 15% in its portfolio. These monthly income plan are essentially debt-oriented funds which provides luxury of liquidity and the dividends in a regular fashion. MIP are ideal for those who can take a little bit of exposure towards equity market, but majorly risk averse. When choosing a monthly income plan, the investor should research the portfolio manager's experience as the fund performance demands highly experienced professionals. There is no lock-in period for the MIPs. The risk in this kind of funds are usually based on the percentage exposure towards equity allocation. These funds are moderately risky and they invest mostly in the debentures, public securities, and corporate bonds. The returns of MIP has some short-term tax implications and long-term capital gain tax implications. The monthly return is not guaranteed and sometimes on the portfolio manager's discretion, the monthly return may be skipped. All the monthly returns are taxed according to short-term capital gain. Thanks very much for sticking around and going through the whole video. If you like the video, please mark thumbs up. Punch the notification icon which will notify you about new upcoming videos. Also subscribe to the channel and share the video with your family. With that, we will see you soon in the next video on how to choose a debt fund. Till then, bye bye and see you.